Hey everyone, welcome back to Corporate Decoder, the place where we dive into the exciting world of corporate filings. Today, we're cracking open the Manitowoc Company's latest 10K report, their annual checkup with the SEC. Don't worry, we'll make it less boring than it sounds, even if we're dealing with cranes instead of, say, spaceships. This report basically says Manitowoc, a company that makes cranes, filed its annual report. The big picture is that they're talking about how they did last year, what could go wrong, and some of the important people running the show. So let's get into it and see what Manitowoc has been up to. First, a word of caution. They have a section called Cautionary Statements regarding forward-looking information. This is where they remind everyone that they're making predictions about the future and things might not go as planned. They use words like expect, believe, and anticipate, but also warn about risks and uncertainties that could throw everything off. So keep that in mind as we go through this. One of the big risks they highlight is macroeconomic conditions. They mention inflation, elevated interest rates, and supply chain problems that have been impacting their ability to turn orders into actual sales. Geopolitical events are another concern, specifically the conflicts in Ukraine and the Middle East, which could disrupt markets and mess with commodity prices. They admit that they face some pretty stiff competition in the market. Some of their competitors might have more resources, better name recognition, or be able to sell their products for less. If Manitowoc can't keep up, their sales and profits could take a hit. Sales are cyclical, meaning they go up and down depending on the economy and other factors. If the economy weakens or customer demand drops, they could be in trouble. Also, their sales rely on government spending and customers needing to replace old equipment. If governments cut spending or customers delay new purchases, that would hurt too. The cost of raw materials like steel is a big deal. If prices go up a lot or they can't get enough materials from their suppliers, it will hurt their bottom line. They also have operations overseas, which come with their own set of risks like political instability, trade barriers, and changing regulations. To stay competitive, Manitowoc needs to keep coming up with new and innovative products. But there's no guarantee that customers will actually want them. If they don't, or if their new products aren't successful, that would be a problem. Their manufacturing and service facilities are vulnerable to interruptions. This includes things like supply chain constraints, technical problems, natural disasters, or even pandemics. Any of these could delay production, increase costs, or lead to customers canceling orders. Their success depends on having talented employees, especially their executive officers and managers. If they lose key people or can't attract new talent, that could slow down their growth. They also need to keep up with the latest technology and manufacturing processes, which can be expensive and require skilled personnel. They rely heavily on information systems to run their business. If these systems crash or are hacked, it could disrupt their operations and hurt their reputation. They're also pursuing acquisitions, strategic alliances, and joint ventures, but there's always a risk that these deals won't work out as planned. They rely on a network of distributors to sell their products. If they can't maintain this network or if distributors don't perform well, their sales could suffer. Rising costs for labor, raw materials, and energy in many countries could also squeeze their profit margins. Labor relations are also a factor, with about 27% of their employees covered by unions. Any major labor disputes could disrupt their operations and damage their reputation. Finally, natural disasters, pandemics, and other crises could negatively impact their business and financial results. Some of their customers depend on third-party financing to buy their equipment. If financing becomes difficult to obtain, or if the value of equipment declines, the company may incur additional costs. Also, they have debt, which can make them more vulnerable to economic downturns and limit their flexibility. Exchange rates can also impact their profits. Because they operate in many countries, fluctuations in currency values can significantly affect their financial results. Audits are a factor too. They could face additional tax liabilities if audits go against them. A significant amount of their assets are tied up in goodwill and intangible assets. If these assets become impaired, it could hurt their profits. They also have pension and post-retirement benefit obligations, which are based on estimates and assumptions. If those assumptions turn out to be wrong, their funding obligations could increase. There are a lot of laws and regulations they need to follow, including environmental regulations, trade laws, and anti-bribery laws. Failing to comply with these could lead to fines and other penalties. They also face potential product liability claims if their manufacturing processes are faulty or if their products have design defects. Protecting their intellectual property is also vital. If they can't defend against infringement claims or maintain their rights to use licensed technology, it could negatively affect their business. Also, they are not able to meet customers' expectations. This may have adverse consequences on business. The company faces risks from cybersecurity threats. They have a cybersecurity risk management program and a team in charge of things like recent cybersecurity developments, vulnerability assessments, and related remediation plans. Moving on, the report also covers some basic financial data. The aggregate market value of their stock held by non-affiliates in June 2024 was about $389.2 million. As of January 31, 2025, they had approximately 35.1 million shares of common stock outstanding. Reduce the company's environmental impact. They have a strategy called CRANES plus 50, aimed at growing their non-new machine sales to $1 billion. This involves expanding their tower crane rental business in Europe, growing their tower crane business in the Middle East, expanding aftermarket activities in North America, and leveraging their all-terrain crane development. They emphasize the health and safety of their employees. One of the key components to that is that our learning and development programs are designed to help employees achieve their full potential by building technical, operating, and leadership capabilities at all levels. Now let's see how they financially did this year. Consolidated net sales for the year ended December 31, 2024 decreased 2.2% to $2178.0 million from $2227.8 million for the year ended December 31, 2023. The decrease was primarily attributable to lower new crane shipments in the EURAF and MEAP segments. Engineering, selling, and administrative expenses for the year ended December 31, 2024 decreased 3.8% to $315.7 million compared to $328.3 million for the year ended December 31, 2023. The decrease is primarily due to $12.3 million of lower costs associated with a legal matter with the U.S. Environmental Protection Agency. Interest expense for the year ended December 31, 2024 increased 13% to $38.3 million compared to $33.9 million for the year ended December 31, 2023. The increase was primarily due to higher average debt and higher interest rates on borrowings from the company's ABL revolving credit facility. Other expense net for the year ended December 31, 2024 was $0.4 million and was primarily composed of $2.9 million of pension benefit and post-retirement health costs. During the year ended December 31, 2024 and 2023, the company recorded a benefit for income taxes of $44.1 million and a provision for income taxes of $5.0 million, respectively. America's segment operating income of $103.7 million decreased $8.0 million in 2024 from $111.7 million in 2023. The decrease was primarily attributable to the lower sales, unfavorable product mix, and $4.8 million of higher engineering, selling, and administrative expenses. EURAF segment net sales decreased 8.0% in 2024 to $616.0 million from $669.6 million in 2023. The decrease was primarily attributable to a lower number of new crane shipments. MEAP segment net sales increased 5.0% in 2024 to $364.4 million from $347.0 million in 2023. The increase was primarily attributable to $9.3 million of higher non-new machine sales as a result of higher used crane shipments. Outstanding debt as of December 31, 2024 and 2023 is summarized as follows. As of December 31, 2024, the company has purchase obligations of $890.4 million with $601.9 million due within 1 year. Purchase obligations consist primarily of open purchase orders for raw materials and various components used in the manufacturing process and purchase obligations from agreements with various suppliers that include a right of cancellation. In 2024, cash contributions by the company to defined benefit pension, post-retirement medical, and other defined benefit plans were $9.1 million, and the company estimates that its contributions in 2025 will be approximately $5.2 million. The Global Information Services team monitors the prevention, detection, and mitigation systems in real time and reports such threats and incidents to the Director of Cybersecurity, Senior Vice President Global Information Systems, the CEO, CFO, General Counsel, and other members of management when appropriate. And with that, let's dive into my take on things. I have to say, MANITOWOC is in an interesting position. They're facing some tough economic conditions and geopolitical uncertainties, so their ability to grow is limited. Still, the company is trying to be proactive and innovative in its products and services. The biggest risk I see is the amount of debt they have, even though the debt agreements restrict their ability to take disadvantageous actions. If the market gets rough for longer than expected, MANITOWOC could have trouble meeting its debt obligations. It will be important to watch closely how well they manage their costs and working capital in the coming year. The company's aspiration is to get a 15% adjusted return on invested capital. That's a pretty ambitious goal that could potentially lead the company to perform better. The company has to perform on the customer service. If the customers have any problems, the clients could reduce profitability, increase warranty costs, government investigations, and/or damage their reputation. Overall, MANITOWOC faces real challenges, but they're not sitting still. This is a company to watch closely as they navigate a complex and uncertain market. Thanks for watching, and if you found this helpful, hit that subscribe button, give us a thumbs up, and let me know what other companies you'd like me to decode in the comments below.